Hello and welcome. This is Extreme Crypto. This is where I'll be telling you things you need to know before you start trading cryptocurrency. Well, a lot of people just pick up their phone or up their system and say they want to start trading cryptocurrency. Actually, it is a nice idea, but there are some set of rules that have to guide you before you enter into it. Well, I've been trading crypto for almost half a decade now, and I've been liquidated, profitable, and sometimes I have to start all over again before I understand that there are some things that they have to be in place, a set of rules that no matter how or no matter what, it has to be followed. And I'm here to share the rules with you. The main reason why I'm doing that is that I want you to learn from my own history, because if you don't learn from history, how are you going to rewrite the future? Your own future is very important now, so it is better you learn from somebody else's mistake than you committing the same mistake again, which it will not be profitable at all. So somebody has made a mistake and has documented it and find the solution around the mistake, and the best thing for you is to learn from it instead of you committing the same mistake. So let's get started now. Rule number 1: know how much to invest. Don't invest at the cost of ruining your life. Your investment should always be something almost insignificant. If you lose it, well, it will hurt you a bit, but that should not be the end of your life. You shouldn't go all in with everything you have in your account or all your life savings. That's not the way to start investing in cryptocurrency or the way to start trading cryptocurrency. Don't invest more than you can afford to lose. Actually, it is a business, it is a trade. You always lose and you always win. So if at all you are losing, it should be something you can afford to lose, not something that it will be too much for you to lose. And when you put the money that is too much for you to lose, it will start clouding your judgment. You become irrational, and the decision you are meant to make when the trade is going against you or when the trade is going for you, it will be clouded. You start making stupid mistakes, stupid decisions. So don't invest more than you can afford to lose. Don't borrow money or take loan to trade. This is a mistake majority of people make when they want to start cryptocurrency, because what some people hear is that crypto is a get rich quick something, like you just bring money and in the next one day or in the next 1 week your money will double, or you see times 5 of your money. Actually, it might be true, and actually it might not be true. But the best thing to do is to trade with your own money. If you go around borrowing money to trade, it is also the beginning of your disaster, because the market is very volatile. Anything can happen at any time, and the money you think you are investing into the crypto will turn to dust in a matter of minutes, in a matter of days. So you are now left to make a decision. Let's say a trade is going against you, you are left to make a decision, and because you have borrowed the money, you might be looking at it that, what if I close this trade now and it starts going up again? Or what if I take profit now and I can still make more of it? Because probably you are looking at it that, okay, let's say you borrow $100 to start the trade, and at the long run you're already making $50, and instead of you to take profit and go away with your profit, you might be looking at it that, what if I can make more and I'll pay off my debt immediately I'm out of this trade? That can actually happen, but what if you start losing the money? So borrowing money will cloud your judgment to make the right decision. So at the long run, you will end up blowing up the money. Let's go to rule number 2 now. Learn to insure your capital. In cryptocurrency, you cannot and you will not survive in the long term without without insuring your capital. It's like when the trade is going against you, what do you do to make sure your capital is safe? And before you even open up a position, what are the things you need to know? So the first thing here is that for every trade you are going to open, for every position you are going to open, there should always be a stop loss. The meaning of stop loss is that when you are running at loss, at a particular point, your loss should be stopped. Like you make a trade now that, okay, for example, BNB will start going up at, let's say you enter at $200, that BNB will go up, and immediately you open the position, BNB start coming down, and 190, 170, 165. Look at the percentage of loss you have accumulated within that period of time. So if there is no stop loss, your money will keep going down. And at the long run, you might lose everything. Let's say, for example, you are trading futures or margins, you might get liquidated out of the market. But if there's a stop loss, you probably look at it that, okay, BNB will go up, and at the long run, if this trade goes against me, okay, I want to leave the market. I want to close the position at when BNB is at, let's say, I said, okay, I want to close the position when BNB is at 185. So if I open the position at, let's say, 200 and it gets to $185, the position will be closed automatically. So I'll still have some of my capital left. So the main reason why you need stop loss is that there are many opportunities in the cryptocurrency market, and if at a particular time you enter a trade and it goes against you, it doesn't mean there will not be a trade that will go for you again. But if a particular trade you have opened the position and it's going against you, and there's no stop loss for that position, you might lose all your capital, and eventually if there's another opportunity that opens up again, you won't be part of that opportunity because you have blown your capital, and at the long run you won't be able to enter the market to enjoy that opportunity. The second thing here is that there should always be a risk management. Risk management is, if you're opening a position, what is your risk reward ratio? Okay, for example, like the BNB we talked about earlier, if I open BNB and I said, okay, I want to open BNB at a particular position, let's say I'm entering BNB, my entry is at $200. So my take profit now, if I set my take profit at, let's say, 220, take profit 1, take profit 2, let's say 235, take profit 3, let's say 250, and so on like that. So if I hit my take profit 1, what percentage will be the profit compared to the position, the capital I'm putting in to open that position? So if I also put my stop loss at, let's say 192 or let's say 190, what is the percentage loss I've accumulated? So the risk reward ratio, if you are opening a trade, you are risking your money. No matter how, if you are opening a trade, you are risking your money. So if this trade goes against me, what is the risk reward ratio? Am I going to lose more than I will gain if I open this position, or am I going to gain more than I will lose if I open this position? So it is important that we take into consideration these two options, because these two options are what people do not consider at all when they are trying to open a trade, because it is actually complicated, and the way they sound, it sounds so technical that a lot of people tend to skip it. So they just look at it that there's no point in putting up a stop loss, or there's no point in putting up to do a proper risk management. So the main reason why they are saying there's no point to put a stop loss is that probably they are looking at it that you are being negative minded if you look at it that a trade will go against you. So you should always be positive minded. But the way cryptocurrency is, it doesn't mean that you are negative minded or you are positive minded. It is just that you have to be logical in what you are doing. A trade can reverse against you. If you have done your analysis now, it might be your fundamental analysis that is wrong or your technical analysis that is wrong. Something might just be wrong along the line, and the way to protect your capital is to have a stop loss and to do a proper risk management. If at all my trade is hitting the stop loss, what is this amount I'm losing from it? So number 3 now, trade spot, then margins of futures. So you can't become a professional in one day. A lot of people believe that instead of trading spot, which is 1-to-1, the leverage is 1-to-1, they want to make cool cash, they want to make instant money, and instead of knowing how to trade, open trade, the risk management, stop loss, and to know the rudiment of the trades, they just go straight directly into margins of futures, hoping that they can double or triple their money in a twinkle of an eye. It's actually a cool thing to trade margins of futures. But before you do this, make sure you have traded spots to a level where you know that, okay, you know the rudiment of trading, you know what stop loss is, you know what risk management is, you know what limit order is, you know how to close a position and things like that. And you also understand what are the leverage margins and how the leverages are calculated, and all other things that has to do with margins before you enter it, or things that has to do with futures before you enter it. So you have to practice, watch live charts, you know how to draw your level. Then after you are comfortable with doing all this, then that is only the time you can say you want to move into margins of futures. So don't rush yourself. Trade spot and learn the rudiment of trading. It doesn't mean if you trade spot for 30 days or 3 months, it doesn't mean. What it actually matters is that you know what you are doing. Rushing into futures or margins will not guarantee that you make profit, and trading spot for 40 days or 3 months will not guarantee that you won't make money. So it is just knowing what you're trying to do. It's just like a professional athlete now. There are levels you have to play in before you go into these senior categories, or before you say you want to play for a professional teams. You don't just train 30 days and enter into the professional team or into the professional level of your athleticism. You have to pass through some stages. People have to assess what you are doing. They have to know if you are ready for the professional level. You understand now? So trade sports, then margins of futures. The fourth one now is, don't be a hero to fight the trend. The market always goes up, down, or consolidate. Just follow the trend. What is there in cryptocurrency is that, like we have said before, it is very volatile. There are sometimes the market will go up, and there are sometimes it will go down, and there are sometimes it will just be sideways or consolidated. So if the market is going up, you have to follow that trend. You have to be bullish with the market. The market is going down, you have to also be bearish with the market. And if it is consolidated, you just have to keep watching, or if there's a way, if you know about scalping, you can be scalping the market. But if you don't know about that, you just have to stay one side and keep watching the market. So the main reason is that we are here to make money. Don't just open a position and look at it that, okay, because I open a bullish position and the market is bearish, and all of a sudden you look at it that, okay, it will go up, and at the long run it doesn't go up. So you have to make sure that you know which trend you have before you open a position. If the market is bearish, you don't go against the market. If the market is bullish, you don't go against the market. You just follow the trend of the market. Number 5, there are no good assets. So here, there are no good or bad assets. Don't get attached to a coin and you are aiming to believe that the coin will keep going up when actually the coin is going down, and you just get attached to it because you look at it that it's a good project, it is this, it is that, it has good fundamentals, and so on and so forth. You don't get stuck to a particular coin and say because it is a good asset. There are no good or bad assets. So the aim here is to make profit. So if a coin is going against your analysis, you leave the coin and move on to another coin, and forget that BNB is actually owned by Binance and it is this, it is that, it is a coin for making transaction fee and a whole lot of that. It gets used every day, and then all those things, it's actually a good fundamentals for the coin, but you are to make profit. If you are holding BNB, let's say BNB, you bought BNB at 500 and now BNB is at 300 and something, and you look at it that you are still holding it, it will go up one day, it will go up one day. Look at the percentage loss you have accumulated from 500 to 300. Look at the percentage loss that you have accumulated. So at the long run, you are the one that will be at loss, and it's not that BNB will give you money if you are not staking your coin. If you are not staking your coin, actually you are just holding it and you are not staking it. It's not worth it to hold it for a very long period of time. You can just look into another coin and make all your losses back. But if you are holding BNB, you are just holding money, and at the long run, there's no profit if you are not staking the coin. Every asset has the potential to take you to the moon or wreck you. Just like we have discussed, if you have a coin, forget about the fundamentals behind the coin. There are many coins that people say they are meme coin, like Dogecoin. A lot of people have made millions from it, and to some people it's just a meme coin. It doesn't have any use and things like that. A lot of people also said many things about Shiba Inu. It's a shit coin. it is this, it is that, but people have made millions from it. So your point is to make profit. You understand now? Your point is to make profit. Know when to enter a coin and know when to exit. And if you are investing in a coin, know when to do DCA. There's something we call DCA, dollar cost average. You keep buying a coin when it keep hitting a new low. For example, now let's say for example you bought FTM at, let's say $7. You discover that okay, it has dipped to like $6. You bought again. Look at it again, it has dipped to like $5. You bought again. So at that particular point, you are doing what we call DCA, dollar cost average. You are averaging the amount your coin is costing you. So if eventually it goes up, you will be in profit, not in loss, compared to somebody that just bought a coin or that just put all of his investment in a coin at once and hoping that it will keep going up. You add the coin at 500, and at the long run you are not doing DCA on the coin. Eventually you'll be at loss, or if you cannot wait for a very long time, you'll be at loss eventually, because it might take 1 year for the coin to go back to the particular price you bought it. It might take 2 years. So the point here is to make profit, not to be an ambassador for a particular coin, or just to keep hoping that a coin will move tomorrow or something like that. So keep your logic, keep your attachment and emotion away, and trade whatever the chart is giving to you. If the trend is bullish, trade it. If the trend is bearish, trade it. The next one, exit at the first sight of bearishness. Don't pray for a trade to go right. Don't hope. This is what most people do. They enter into a particular trade and they discover that the trade is going down, it's becoming bearish, and they hope that okay, it will go up, and they keep putting in money. Let's say for example you open a margins or futures position and you enter and you discover that the trade is going against you. Instead of you to have set up a stop loss and you take your loss and continue with your life, so most people will come again and start putting money into the trade, hoping that the trade will come up tomorrow. And what you are doing is that you are digging yourself down more. That is where your insurance comes in. If there's a stop loss, allow your trade to hit the stop loss and you move on. Cut your losses and keep them small. Like we have said, it's fear to just accept that you have made a bad analysis, or probably the market just went against you. Not like your analysis were bad and you were sure of what you were doing, but at the long run, a news might just happen in the market and it will change every analysis that you have made and make it invalid. So you just have to accept the loss and continue with your life. So cut your losses and keep them small. Exit and start afresh. Like we have said before, there will always be an opportunity for you in the market. So what you just need to do is that at the sight of the bearishness, allow your trade to hit the stop loss and leave the market. And if you don't have a stop loss, which is a bad idea, just exit the market and look for a new opportunity. Start afresh again. Number 7 here now is plan. Don't trade if you don't have a plan. And what we mean by plan is that you should have a trading capital, plan on how much you are going to trade with. That's what we mean by a trading capital. How much you are going to open a position with, that's the trading capital. A trading position now, the position before you enter a trade, what position are you going to open? If you are going to open a long position, okay, how much are you going to open it with? If you are going to open a short position, how much are you going to open it with? Entry now, for every trade you should always have an entry, and there should be a reason why you are entering the trade. Not that probably because somebody told you that okay, this is going up, you now go up and you went ahead to open a position without even knowing why it is going up. And if somebody told you that okay, this is going down, you went ahead to open a short position on it without even knowing why it is going down. And again, mistakes some people make is that at a particular point when they hear a news that okay, coin is going up, or somebody is already at a percentage profit on the coin, they will rush ahead to open a position on the coin. There should always be a reason why you are entering a position. You understand now? So some people, they don't even mind buying a green candle. They buy a green candle and thinking that they have opened a long position. It might later be against you. You have to have a reason why you are entering a position, and it is very important. There should also be a plan to exit the position you have opened. There should be something we call take profit, and there should be something we call stop loss. You notice that we have been emphasizing on stop loss because trading cryptocurrency is a probability. So what you work with is statistical data. What happened yesterday in the market, the all-time high, the price the market closed, and the price the market opened, and you look at what was the fight between the bear and the bull. All those things are just the data you use in opening a position. If you have entered a position, there should also be a way for you to exit. This is what we mean by take profit. You should know when to take your profit, because some people might be on a particular position and they are already in profit, but greed will not let them leave the market. So they will look at it that they can still make more. But what some people don't understand is that it's not a coin that will make you a millionaire in a day. It is possible a coin might make you a millionaire in a day, but you might have been owning the coin at a very long time, and you might have also entered the position when the coin was very low. So if you are not trading a particular coin and you're hoping that you see a particular percentage there, which might be realistic or unrealistic based on your own analysis, so there should always be a particular point in time where you take your profits. Don't allow greed to come into you, because at the long run you have yourself to blame. So there should always be a particular time you take profit, and there should always be a stop loss for you, because stop loss is what ensure your capital. In case the trade goes against you, I'm leaving the trade at this particular point. So that is the meaning of stop loss, and at the long run you have the opportunity to enter another market again and probably make profit, or probably recover what you have lost from that market. So there should always be an exit point. The next one now is keep it short and simple. This aspect is for the newbies that they have a lot of imagination about the way traders are. You don't need expensive gadgets or multiple screen. Some people, their imagination is that you have to buy a very expensive laptop, like a gaming laptop, or you need multiple screen, or you need to be seeing 5 or 7 graphs at a time. Actually, that is what they put on social media to present themselves as a professional traders. When they take pictures or when they do videos, they make it look like they are opening 5 screens at a particular point in time, or they are watching 5 or 6 screens all together and seeing what is happening at different time frame. Actually, some people do that, but most of the time you don't need all this. What you just need is just your laptop and your phone. Most of the time you can even work on your phone, so you don't need multiple and expensive indicators to trade. Well, another thing we need to know again is that some people believe that they need to buy a bot, or they need to buy expensive indicators to trade. An indicator that will tell you that, okay, this is time to buy, this is time to exit. Like I told you before, most indicators, what they do is analyze the data in the market. Like they analyze the statistical data in the market, which it's what has happened in the market, not what is going to happen. That's what people don't know. Indicators are for technical analysis. What has happened in the market is what they use to predict what might happen next. What might happen next? You have to take note of that term. That is probability. They don't know what will happen exactly. That is why you have to understand that your fundamental analysis has to go together with your technical analysis. What might happen next? So if you are buying an expensive indicator now, you bought an indicator for $200 and it's telling you this is when to buy, this is when to sell. It is possible actually, but if you don't know what is actually going on in the market, and an indicator tells you that, okay, this is time to buy, you enter the market and the market start going against you, what's not the point of that? So you just have to keep it simple. My mentor actually still trade with support and resistance and Fibonacci majorly. He knows what he's trying to look for. Just draw your support, your resistance, and do Fibonacci, and at the long run the result, analyze it together with the fundamental analysis and opens a position. So there's no expensive indicator there, just normal indicator that are readily available on any trading tools. So keep it short and simple. Number 9, practice and trade more. That is how to get better at trading. You cannot just sit down and want to know everything at a go. So what you need is to practice more, trade more. For you to be better at something, there's something they call 10,000 hours. You need to have spent 10,000 hours practicing that thing. So for you to be better at something, so you need to just keep practicing. That's why professional athletes, there's a practice time for them and there's a training time for them. So before they start a professional match or professional competition, they train every now and then. And the main reason is that there are some things you have to do in training, and when it comes to the actual competition or actual match, you remember that, okay, I've actually done this thing in training, and from there you'll be able to implement it. It won't be something that will take you as shock. So because you have traded a lot and you have practiced a lot, you would know that, okay, if something like this happens, this is what I'm meant to do. If something like this occurs, this is the next step I'm to take. Study the trend and trade it. So when you practice, you start understanding what we mean by trend, what we mean by bullish trend, what we mean by bearish trend, and the market consolidating. So when you start practicing a lot, you understand all these things. So you study them and you trade them. That is the way to be a profitable trader. So the last on the list now is you need to learn, unlearn, and relearn. Journalize your trading. You need to journalize your trading, like every trade you have made, every position you have entered. Why did you open the trade? Why did you enter that position? And what was the profit you made, or what was the loss you accumulated? What happened? Why the trade went against you? Was your analysis wrong, or was there something that happened in the market that changed your analysis from being right to wrong? So you should journalize the trade. How long did it take you to hit your take profit, or how long did it take you to hit stop loss? So you need to journalize your trade. You evaluate your trading activities and learn from your mistake. Everything that you have journalized, find a particular day, you look into them, probably Sunday or Saturday, and you look into them and look at every activities that you have traded, every coin you have traded, why you traded the coin, what was the reason why the coin didn't go the way you expected it to go, and things like that. You look at every activities of your trade and you learn from your mistake. Trading is a very rewarding activity, so it is very profitable, so you don't expect it to be easy. There should be a plan for you to follow if you want to be a professional trader. So you don't expect everything to come easy. So you have to take charge of everything. You have to also put effort into everything. It's just like you are going to a college now to become a professional doctor, or to become a professional accountant, or a professional engineer. So there are some trainings you need to go through, and there are some rules and regulations that will have been given to you, that if you want to design a particular building, these are the steps you take. If you want to do this, if you want to do that. If people can take 4 years, 5 years in college, what's stopping them from taking time to learn what they are actually putting their money into, and is actually more rewarding, or as rewarding as going to college? You understand now? So you don't expect all this to come easy. So these are the 10 rules now. Actually, I've put them down based on my experience in the trading world. I will advise you not to fight against them. It might sound unrealistic, or probably you might be looking that it is difficult for you to keep all of them. It is actually not difficult if you put your mind into it that you want to do them. Let's just go over it again. Let's look at the summary again. So number 1, know how much to invest. Number 2, learn to insure your capital. Number 3, trade spot, then margins of futures. Number 4, don't be a hero to fight the trend. Number 5, know good assets. Number 6, exit at the first sight of bearishness. Number 7, plan. Number 8, keep it short and simple. Number 9, practice and trade more. Number 10, learn, unlearn, and relearn. So these are the 10 rules that will guide your cryptocurrency trading journey. I hope you find all these interesting and you have learned one thing or the other. So don't forget to subscribe and turn on your bell notification for more video. Thank you.